Finovate showcases cutting-edge banking and financial technology through a global conference series featuring short-form demos and thought leadership. Now, the conversation continues on the Finovate podcast.
Hey, welcome to the Finovate podcast. We've got another fun one for you today. We are continuing our exploration of the FinovateFall 2024 Best of Show winners. And joining me today, we have Nathan Pinto, CEO and co-founder of Credit Mountain. Nathan, thanks for joining me.
Hey, Greg. Glad to be back and awesome to be talking with you again.
Excellent. So as I mentioned last week, you can find all of the demo videos from FinovateFall up online at finovate.com/videos. And you can check out Nathan's demo video there to see the full piece that he showed our audience. But Nathan, for people who weren't able to see that video, can you start with just a little bit of background on yourself and a quick intro to Credit Mountain?
Sure, of course. So background on myself, I've been in the fintech space now for about 6 years. We spent 3 years trying to take on payday loans and really started to understand the struggles of consumers and their ability to access credit. And while driving into them, we saw that those who access credit consistently have a really tough experience, and that has to do with when they get declined for a loan. So Credit Mountain's on a mission to reinvent the decline experience and allow credit unions and banks to provide people a much better and much more informative experience when they get declined that ultimately drives revenue and cost savings throughout the process.
Yeah, no, it's a really cool demo, and I would encourage anybody to go and take a look at it. One of the key phrases that you brought up in your demo is the idea of a warm decline. And I want to start by kind of talking about the other side, because there's an implication if there's a warm decline, there must be a cold decline, which I think is a process that a lot of financial institutions are using right now. Can you talk about what that cold decline looks like?
Of course. I mean, I think it's one of the things that always stands out, that most of the folks that we engage with are not those that are being declined. And so more than often, there's a lack of remembrance or even awareness of what the decline process today looks like for those who ultimately are rejected upon applying. And for the vast majority of people, what happens when they apply is that they might get some communication upfront on the online website, or they might get some notification on email saying, "Hey, unfortunately, you've been declined." But really, from a regulatory and lack of human capital perspective, what winds up happening is folks just get this letter in the mail, and it's a letter in the mail that tries to detail the reason that people were declined, but because it's so form language and because it's all templatized, it's really kind of a cookie cutter letter that really leaves the consumer confused, not really understanding why they were declined. And because of that, that's frustrating for people. It hurts to be rejected. And a lot of times we talk with folks, and we like to use this analogy around what is the warm decline. And I think a fitting analogy is breakups, and when a couple that's dating breaks up. And there's traditionally two ways that things go down. If you're at a restaurant and the couple next to you breaks up, there's the worst version of it, where somebody gets up, screams, "I never want to see your face again," and throws water at them. And there's another version of a breakup where they're still breaking up. The people might be sad. One of the partners might be crying, but ultimately there's a gratitude for, "Thanks for being open and honest with me. Thanks for helping me understand what I could do to be better, and how and what was good about myself." And ultimately they still get up and part and go separate ways, but they're broken up, but there's that doors open for a future relationship, whether that's dating again or whether that's being friends. They're open to seeing each other, and they appreciate each other. And honestly, I think in 2024 and with the space that we're in, and trying to compare it to this letter that comes in the mail, I think the cold decline better represents the worst form of breaking up, which is when somebody just sends you a text message and essentially ghosts you.
Yeah, I think, and when you kind of frame it in that way, it's easy to see how, difficult this can be if you're on the receiving end of it, to just kind of get this, single answer, no. And to your point, you don't have a lot of clarity in terms of why you got rejected. And so let's switch gears now and talk about what the warm decline looks like. And this is something which you laid out very comprehensively in your time on stage, but I think it's important for our audience to get a sense of how a warm decline is possible, and where the various areas where that's obviously substantially better than the cold decline.
Yeah, before we got this started, actually, we talked about 100 different folks. We used a research firm, and we had them interview 100 people who were declined for a loan in the past 6 months. And we heard consistently over and over again the same sort of analogy listed in that previous question, which was, what I really want is transparency. I want transparency. I want to really understand what it was. It feels a lot less personal when it's actually more empathetic and directed to an actual individual versus just a boilerplate. So the warm decline starts with rethinking the adverse action notice. In large part, most institutions haven't moved from printing and mailing due to some technical limitations that we've managed to solve by building an intelligent workflow behind the scenes. But by leveraging that intelligent workflow, we're able to deliver 80% of electronic adverse action notices digitally. And when we give the digital adverse action notice, we really rethought, and from a compliance perspective as well, but does it need to just be this sort of like boring PDF letter? And really what the regulator showed us was as long as it contains the right information, really the sky's the limit. And so with that sort of clean slate approach, we rebuilt the adverse action notice to be a digital dashboard that when people click to learn more about why they've been declined, they're able to see a full breakdown of all the reasons, paired with different articles, tools, tips, data to help equip them with that clarity and informative aspect. And from there, when somebody understands why they've been declined, the next question is, where do I go from here? And for that, we generate what we call a personalized path to yes. So this is where a declined borrower, whether a member, non-member, will need to verify themselves. And we have the phone number on record coming right out of the loan system. So we send a text message right to their personal device. They authorize themselves. And now we're doing a soft pull behind the scenes to understand, okay, what does this individual's credit look like? From there, we match it up against the underwriting parameters given to us by the institution. So what does the credit box look like? What are the targets somebody needs to reach to be in a place to reapply? And then secondly, what does each of those decline reasons mean? And because the decline reasons are often vague as well, we really take an extra effort with each institution to really understand what a decline reason could be. And then with sort of the vantage point of an underwriter, once we get that credit pull, we try to match it together and say, okay, I see what aspect of this the underwriter was declining them for. And so with the personalized path to yes, we're able to see where somebody is, where they need to get to, and why they were declined. And with that data, we create this step-by-step action plan. Once again, we have a whole arsenal of tools, tips, partnerships that could really help somebody close those gaps that they might have. And then the beauty is that ongoing nurturing, that it's, yes, you've been given clarity on why you've been declined, you've been given a path forward, but beyond it, we're not just going to leave you there. We're going to hold your hand throughout this journey by continuously refreshing your progress, sending you reports how you're doing, and also looking out for you, because with this sort of ongoing credit monitoring that's taking place and this understanding of the institution's underwriting parameters throughout the time that you're working towards a yes, we're also looking to see if there's something else this institution can do for you. And whether you call that a cross-sell or you call that financial coaching, I think regardless, as long as you're helping the consumer have a better financial outcome, that should be the ultimate thing that we're striving for anyway.
Yeah, no, absolutely. And I think, to bring it back into the context of what you were talking about earlier, preserves the relationship. It means that there's a possibility for a future relationship of some kind. And especially, I think, a potentially very loyal relationship. If you're able to help a customer figure out what they need to do to be able to get the access to those types of products, they're able to go and satisfy those requirements and come get it. This is the type of thing that people remember, right? This creates this human connection. I want to talk about the fact you mentioned that credit unions specifically are a really good target market for you. Why is that group the right fit for Credit Mountain?
For sure. Well, I think, we got our footing with the credit union movement, and prior to that, we had very little, knowledge about the movement. And what we've come to learn is that really credit unions are designed to serve the customers. And I think in a world of fintech and large mega banks, there's just not a lot of institutions that want to take those risks on certain customers that aren't sort of the super prime, pre-approved individuals. And I think credit unions have done an excellent job of filling in that gap and being these community-focused and mission-driven institutions that are looking to sort of cast a wider net, allow people to feel like they can come in and be more than just a score on a piece of paper. And as a result of being more than just a score, and as a result of actually being a holistic person, I think in that person to person or people helping people, as they say it, when it comes to that decline, which unfortunately happens more than approvals, we see declines continuously rising these days. And, it's safe to say more than a coin flip chance when someone applies, they're going to get declined. And so considering the fact that more people are leaving with a decline than an approval, it says that if we're really here to help people and serve people, there has to be a better way to do it. And I think that credit union's mission and our product really is a perfect alignment.
Yeah, no, I think there is obviously a strong overlap there. So I guess the next question then becomes, what has been preventing credit unions from being able to do this in the past? What's been the biggest barrier from that keeps them from being able to offer this type of service? Because you're right, it does seem like it's something that lines up really nicely with a lot of their goals.
Definitely. I mean, we ask credit unions a lot, and we ask, how do you do declines today? And more often than not, for the credit unions that gravitate to our solution, they've tried this. They've tried to train their staff. They've tried to create different policies and procedures. But the reality is, it's just hard, right? You might have hundreds of loan officers, and for each of those, you have to train them. And on top of it, you're dealing with loan officer turnover. So every couple of years, you kind of have to train new people. And then ultimately, we just have to remember, right? Like there's a phrase I love, which is, show me the incentives and I'll show you the outcomes. Well, the incentives of loan officers is tied towards, closing loans this month, this quarter. And more often than not, the people you're declining are going to need a lot of time. They might need years to be in a place where they're going to be ready to apply for the product they were seeking. And so as a result of it, from a loan officer perspective, they're already slammed. They've already got too many things going on. And so when it comes down to it, with a lack of training, a lack of time, it's really hard to prioritize or make sense as to why you should, follow up with these folks when you also don't know. It's sort of like it's a total guessing game. That's what we've seen over time. What the beauty of our system is, we're able to track sort of the credit migration of individuals. And the reality is it's not that easy to predict, no matter how much machine learning we've thrown at this. It's not that easy to predict who's going to be moving up one paper grade, two paper grades over the course of 12 and 24 months. And so as a result of it, trying to follow up with 100 people to find the 5 to 10 that might be eligible to reapply is just too much time, too much intensive, and really, their priorities are aligned with closing loans today versus, loans that might be there a year from now.
Yeah, and this is, I think, a common refrain. People who obviously have to be focused on the short term, right? So many professionals in the financial services space are incentivized based on this quarter's results, and so there's, as a natural consequence of that, you do sometimes miss these larger opportunities. And I think that it's great to hear people are looking at it, at least from the strategy side of it, as there is an opportunity here. There's a chance for us to go out and create customers that we can then go have a relationship with. There is obviously a financial inclusion angle here as well. And I think that when you're talking about giving people access to credit, expanding access and credit worthiness, you obviously have that financial inclusion tie-in. How much do you like to talk about that? I noticed you mentioned it during the demo, but it didn't seem like a major thrust of what you were presenting.
I think financial inclusion's at our core, and I think financial inclusion is at the core of our target customers as well. So, we don't typically like to be bucketed in that group, but when we do get bucketed in that group, it's usually a win for us because we really focus on the ROI to our customers. And so, unlike many other financial wellness tools that we've seen and interacted with, the ability to point to a really tangible ROI, the cost savings on the printing and mail costs, the cost savings and time savings of the loan officers, the follow-up tools, the cross sales, the nurturing, it really points to a strong ROI. And so, when we do get bucketed into the financial wellness sort of, group of fintech products, it usually benefits us. But at our core, I think, we're looking at ourselves as really a fintech that's focused on reinventing a process that happens and has to happen by law, and really finding a way to do it better.
Yeah, yeah. So I think we have time for one more question, and this is around the response you got. Obviously, on stage, your demo was well received. The audience really liked what they saw. They voted for you. What kind of response did you get from the credit unions that you spoke with at your booth in the networking space? Did most of them, get it? Do you think that they're on board with the mission?
I would say so. Yeah. I mean, I think it's the credit unions who come to us are excited because they've tried this, and that's the common sort of opening line I hear is like, we've tried to do this warm decline. We've been talking about doing this. We've asked ourselves, how can we help the 60% of our applicants that were declining? One of the people that came to my booth, due to low liquidity and sort of the crumbling resilience on the subprime market, they're seeing their decline rates go from, on average on 50% to now over 75%. So 3 out of 4 people that are engaging with their brand are leaving with a rejection. And so the last thing you want to do is burn a bridge with 3 out of 4 people who then as the data shows, 80% of people you reject will never come back to apply with you again. The last thing you want to do is be burning a bridge with tens of thousands of customers. And so our solution really comes in a way that it won't take the time and effort it would take to train their staff and implement, various things that aren't aligned with the staff's incentives anyway. And at the same time, save them money by, this institution is probably printing and mailing 5,000 plus letters a month. And the cost savings on that alone gets them into an ROI positive space with our solution.
Yeah, no, certainly there's a lot there to like. And I think, again, it's clear to see why you were able to strike that chord with the audience. Again, I would encourage anybody listening to go take a look at the full 7-minute demo video. You can see it for yourself, see it in action. Nathan, thanks so much for taking the time to connect with me. And congratulations again on the Best of Show win.
Thanks, Greg. Appreciate this.
The Finovate podcast is produced by Informa Connect in association with Provoke.fm Media. Check out Finovate.com for information on Finovate's upcoming shows and to learn how you can get involved. The discount code Finovate Podcast will save you 20% on tickets to all of our events. And you can email us at info@finovate.com for information on sponsoring, speaking, or demoing. Thanks for listening.